So gross domestic product, is a key economic indicator that gives us a sense of how big the economy is and how much it's growing. Basically, what economists do, you need to have good statistics to do this, but they just add up um, basically all the money, all the goods and services that are produced by economy. So everything that gets spent gets added up and put into domestic product. This includes consumption, which is household spending, investment, which is spending, and then net exports, which is the trade balance, or simply exports minus imports. And then finally, government spending. So you add up all those things together, that's GDP. And when you measure how much GDP has increased compared to last year or last quarter, that gives you the growth rate. And that's typically what you hear when you hear in the newspaper or something that the economy grew 2.4% or whatever the number is in the last quarter. They're giving you an annual growth rate in the US. But note that in Europe, typically they don't always do annualized GDP growth. They might do GDP growth from a year ago. So Q4 over Q4, the fourth quarter compared to the fourth quarter, or they might give you a number. How much did the economy grow compared to the previous quarter? So be careful when you're using statistics to make sure that you're comparing oranges with oranges. So obviously, when the economy is growing, that's what you want. GDP is positive, but typically, what we call recessions are when GDP shrinks. The rule of thumb for economists is that two consecutive quarters of contraction equals a recession. But there's also other ways to look at GDP. You can look at GDP per capita. That's a good way of comparing things, growth rates across countries. Um, and Anyway, GDP is a good sort of rough number that tells you how big an economy is and how fast it's growing or shrinking. So let's talk a little bit more specifically about Europe and what's been going on. So in the euro area, there have been some large shocks that the euro area has had to weather over the past few years. And I think the key word is that resilience. The euro area has shown a lot of resilience in dealing with these shocks. First, we had the pandemic, which was all over the world. So it was very similar in the US and Europe. But then when Russia invaded Ukraine, that caused a big energy and commodity price shock, and it hurt Europe much more than it did the United States. We'll come back to this, but that was a big shock. And then since then, we've also seen a lot of increased competition globally, particularly from places like China in the manufacturing sector, and particularly the automobile sector. And automobiles are a major part of the European manufacturing sector. And so all these shocks, increased imports of Chinese electric vehicles and things like that, have really been important headwinds to growth in Europe. And this has been a problem, and this is one of the reasons why European growth has been lagging a little bit. And a lot of this is down to the problems that are happening in Germany. Germany has had 2 straight years, not quarters, but 2 straight years of contraction in GDP. And so it's not that GDP has fallen a lot, but it's really been pretty stagnant. And there have been all these challenges buffeting the German economy, and sentiment's very weak there. So just to give you a number, in 2024, Euro area GDP increased by 0.7%. That's compared to 2023. And growth is set to accelerate. It's set to come up to 1.3% in 2025. But that's not great. It's okay. So what's driving this? Well, remember I said before, you can break down GDP into household spending and business spending and net exports and government spending. Well, this chart breaks down GDP by these components. And what it shows you is that higher household spending basically is the thing that's going to be driving growth over the next couple of years. And the reason for that is that despite all these shocks and headwinds and challenges, Europe has had quite a strong labor market. They're creating lots of jobs. People have been enjoying real wage gains, which means that they've been getting raises higher than the inflation rate. And they also have a lot of money saved. And so the fact that households have very solid balance sheets, they have lots of money in the bank, lots of money, saved up. Most people who want a job have a job, and people have been getting raises commensurate or even above inflation recently. So this means that people have money to spend. They just need a little bit more confidence. Another thing that's happening that we'll talk about at the end is the EU's Recovery and Resilience Facility. This is a package of money that was created initially to help counteract the effects of the pandemic, but then it was sort of repackaged to deal with the energy price shock that came from the war in Ukraine. And a lot of this money is now finally flowing into the real economy. The money has been dispersed by the European Commission and is now being spent by the member states of Europe and their governments. And this is most of it's going into investment in infrastructure and green energy and things like that, and it's starting to have a really big impact on investment and growth. So this is another piece of good news. One more thing I'd like to mention is that the ECB has started cutting interest rates, and this makes borrowing cheaper, and so this should also encourage investment. And all these reasons are why the European Commission is forecasting growth to pick up in the next couple of years in Europe. So let's talk a little bit more about this challenging global environment that we're in, and particularly the manufacturing sector. I already mentioned it, but this chart breaks down the different parts of the manufacturing sector. And what you can see here is that the blue line, that is energy intensive manufacturing. That shows you what an impact that higher energy prices have had in Europe. Any factory that depends on natural gas as its energy source or feedstock, and for example, lots of like chemical plants take in natural gas and turn natural gas into various chemicals. These factories have suffered a significant decline in output because they're less competitive than energy intensive factories in the United States or in China and other parts of the world that have access to cheaper energy. Another thing that's been going on is that China has been having some of its own economic problems. GDP growth has been slowing a lot in China. And on the one hand, that means that there's less demand in China for European exports. China has, over the past 20 years, been a major purchaser of everything from European luxury goods and automobiles to machine tools and things that go into creating factories in the first place. So partly there's less demand for European exports. But China, because growth has slowed domestically there, they have massive overcapacity in a lot of their manufacturing sector. And what they've been doing is exporting those goods abroad. And those goods often are cheaper than their European competitors. And so this has been taking market share from European companies rather. So, obviously, that the biggest electric vehicle EV manufacturer in the United States is Tesla. But Tesla was actually recently overtaken by a Chinese firm, BYD, as the world's largest manufacturer and exporter of EVs. So this is a pretty difficult situation if you're running a big European manufacturing firm right now. This chart shows you how much better economic growth is in the United States, has been in the United States recently than in Europe. The red bar there shows you annual GDP growth or year-over-year GDP growth in the United States. And it's been, 2.5%, 3% in every quarter for the past 2 years, whereas Europe has much lower growth. And again, this is attributable to the shocks that Europe has had to absorb. The war in Ukraine is right next door to Europe. It has had a major impact, not just on energy supplies, but all these refugees have come to Europe, caused this spike in inflation, and it really hurts sentiment. People feel it. People feel that this war is right next door on their doorstep, and it makes them reluctant to spend money. This is why consumers have such healthy balance sheets. They've been making money. They're just reluctant to spend it because they're feeling a little nervous about the future. So all these things have been happening, and now there's another risk on the horizon, which we'll also talk about more. But I just wanted to say that with the election of President Trump in the United States is expected to start implementing some protectionist policies. These are things like tariffs on imports from the rest of the world, export restrictions, all kinds of things that are going to make it harder for European companies to sell their goods and services in the United States. And if the protectionism gets bad enough, and we don't know yet, that will also be a drag on European growth. So you might be wondering, wow, this sounds like things aren't that great. What's Europe going to do? And Europe has a plan, and the plan is still being implemented, but I encourage you all to Google the Draghi report. You can find it on the internets, and have a look at it. It lays out a very clear, somewhat concise explanation of what the challenges Europe is facing and offers a bunch of possible strategies and solutions for how to deal with this. Now, what the Draghi report notes is that apart from these specific shocks, you can boil this down to the underlying problem in Europe is really one of weak productivity growth. You also have very aging demographics. People are getting older. There's less workers per the number of people who are retired. And this also strains the economy and budgets in all kinds of ways. But fundamentally, when you're thinking about, what the point of economic growth is, why do we want GDP to expand? Basically, it's to make people wealthier and have a higher standard of living. And over the long run, really the only way to do that is to make each worker more productive per hour that they work. So productivity just measures how much somebody produces in a given day or in a given hour, however you want to do it. And the problem is that European productivity since 2000 has been lagging behind the United States. It's spent about 50 years catching up to the United States after the war. And it got very close to parity. If this chart shows if US labor productivity is indexed to 100, by 2000, Europe was getting very close to American productivity levels. And since then, it's downshifted. So this needs to be fixed. Europe needs to figure out ways to have its workers produce more with less, basically. And the focus here is on Draghi recommends a bunch of ways to improve competitiveness, basically by encouraging innovation. And a good shorthand way to think of that is that Europe needs more high-tech firms and startups. It also needs to develop green energy. And this is referred to as decarbonization. And part of this is because European firms have some technological advantages in terms of being able to build solar panels and electric vehicles and things like that. But it's also because the war in Ukraine highlighted that Europe was importing a lot of energy from Russia, and that ended after the war. And Europe needs energy independence, and because it doesn't have large domestic reserves of oil and gas, it needs to go the green energy route if it wants to have energy independence and reduce external vulnerabilities. So green energy is a big part of that. But another part is because there's this war and hostile power right on the doorstep of Europe, Europe also needs to spend more on defense. So all these things need to get done to improve European competitiveness. And in practice, that means having industrial policies, competition policies, and trade policies that are coordinated. This is sort of the point of the EU. You have a bunch of small, some are bigger than others, but a number of countries that on their own aren't big on the global stage. They're not as big as the United States or China or India or Brazil. But if you put them all together, it's a continent-sized economy that has hundreds of millions of people, and you can really do a lot by coordinating your industrial competition and trade policies at the EU level, and that should help boost competitiveness. So I encourage you to go look at the Draghi report. Okay, let's keep moving. Unemployment. The definition of unemployment is that it's the number of people who are actively looking for work. And typically when GDP is growing and the economy is expanding, unemployment will go down. And likewise, if there's a recession, unemployment is going to go up. Companies are more willing and desire to hire more workers when they can sell more of their stuff. And when people aren't buying their stuff, they're gonna not hire people, or they might even lay people off. Um, so what you can see from this chart is that historically, unemployment tends to be a little bit higher in the euro area than in the US. Um, in part, one of the reasons for this is probably, economists debate this, is because there's more job protections in many European countries than in the United States. And that makes companies more reluctant to hire, even if times are good. Even if consumers are buying their goods, if you hire somebody and then it's very difficult or expensive to fire them, you might be more reluctant to expand and open a new office or open a new factory until you're sure that growth is really booming and going to keep going that way. But apart from the comparison to the United States, the European labor market is actually historically really strong right now. The unemployment rate across the euro area is 6.3%, and that's just a tick up from the all-time low in the history of the European Union of 6.2%, which happened just a couple of months ago. So the labor market is considered tight. And what that means is that firms are really struggling to hire qualified workers for their open jobs. Job growth has been very strong ever since the pandemic, and particularly in service sectors, because as we mentioned, the manufacturing sector is facing some challenges. But service sector job growth, everything from restaurants to professionals like accountants and people like that, there's been a lot of job growth in Europe over the past couple of years, and the labor market's quite strong. Now, I want to add to this, though, that the unemployment rate is a good sort of rough estimate of how healthy the labor market is, but you need to dig a little more into the statistics to really get a fuller sense of how strong the labor market is. Because there's a lot of people who aren't in the labor force, and the unemployment rate only measures the number of people who actively are looking for a job, who want a job, but who don't have one. And there's lots of people who aren't in the labor force for a good reason. Maybe they're students, maybe they're retired, maybe they're recovering from some injury or illness. These people are not counted in the unemployment rate. They don't have a job, but they're not unemployed in this sense. They're retired or they're students or whatever. There also can be bad reasons for not having a job. If you've been looking for a job for a couple of years and you couldn't find one and you get discouraged and you stop looking, or maybe you have a drug addiction, or maybe unemployment benefits are too generous and you don't feel like you really need to work. So you got to weigh all these things when you're looking at how the labor statistics are. But I'm going to turn to the next slide, and you'll see that even though the unemployment rate in Europe tends to be higher than America, the labor force participation rate tends to be better. And this gives you a sense that in the grand scheme of things, the labor markets have some differences, but on balance, they're similarly healthy right now in both Europe and the United States. The labor force participation rate, the number of all people, all citizens, aged 18 to, or I'm sorry, 25 to 54, this chart shows. You can also get it other versions like 18 to 65 years of age. But for adults, the labor force participation rate in the euro area is over 75% right now, and that's compared to just 62% in the United States. So that's a big difference. And for prime age workers, the difference is a little bit less. 25 to 54 is 86% in Europe to 83% in the US. But prime age people should really be working, right? Most of those people, they're not retired, and most of them aren't in school. So if you don't have a high participation rate with prime age workers, that's showing you that something is wrong. Either you have some people with drug problems, or your benefits are too generous, or something like that. And, you know, previously I said that job protection is one of the reasons why the unemployment rate's higher. But a couple of the reasons why the participation rate is better in Europe is things like subsidized childcare, better health care, more generous pension schemes. These are some of the reasons why it's easier for people, more attractive for people to have a job in Europe than in the United States. And you can see that in the participation rates. So, moving along, let's go to inflation. So, inflation, what is it? Obviously, we've just come out of this period of high inflation all around the world. What economists mean when they're talking about inflation isn't simply that the price of eggs went up, it's that there's a general increase across a huge number of prices, not just eggs, but all groceries, and how much a car costs and how much plane tickets cost. They create these huge baskets that measure the prices in a huge number of categories across the economy. That's what the inflation rate is. How much prices are going up across the board. Now, it's useful to know that most economists think that a little bit of inflation is good. You don't really want 0% inflation. When you have 0% inflation, that means that the economy is not growing. Um, so you tend to want a little bit. 2% is what central banks tend to target, 2% annual inflation. But if you get inflation that's above 2%, people start to get annoyed. And that also means that your economy is overheating. It's operating above capacity. There aren't enough workers to get hired. So companies start bidding up wages to hire the people that they want. And that causes wages to go up, and then people have more money. And so they buy more stuff, and it creates this cycle of inflation going up and up and up. You can also have the risk of deflation in recessions where when everyone loses their job and they stop spending money, you can have this downward spiral. So you kind of want a Goldilocks, just enough, but not too much inflation. So during the pandemic, it was really these temporary shocks that caused these big spikes up in inflation. You had this period of very low inflation for a long time before the pandemic, so it sort of took people by surprise. But all the shutdowns to businesses and schools and governments during the pandemic really messed up global supply chains and meant that factories couldn't meet the demand when people's, first of all, they were just having trouble producing stuff when people couldn't come into the office to work or the factory. But then when demand started to pick up during and after the pandemic, it took them a while to get production back up to previous levels. And then, just as the pandemic ended, this war when Russia invaded Ukraine caused all these commodity prices to shoot up. Energy prices went way up. Um, Energy is a basic thing that goes into, you know, even if the stuff that you're ordering from Amazon doesn't, even if the product itself doesn't contain a lot of oil, it still has to get delivered to your house, and that requires, some van or truck to drive it places. Like, this is embedded in the economy, the price of energy. And when energy prices go up, producers tend to pass those costs on. And at the end of the day, it's the consumer who pays for it. So, um, an important thing, though, is that a lot of economists, when inflation was near the peak, were worried that in order to get inflation back down to 2%, the central bank target, that a lot of people were going to have to lose their jobs. And there was a lot of people, a lot of economists worried that the tightening of monetary policy was going to cause a big recession and lots of people were going to lose their jobs. And that was the only way that we were going to get inflation back to target. Now, the truth is, and as luck would have it, that didn't happen. Inflation is now more or less back to target in both Europe and the United States, and it has not been accompanied by a significant increase in unemployment. This is huge. This is a big achievement that I think most people don't appreciate how hard it is for policymakers and economies to achieve this kind of soft landing. This is what has happened. Inflation has come down without major disruptions to the labor market. And it's sort of a funny term, but if you've ever heard economists discussing immaculate disinflation, this is what they mean, that prices have come down without causing a recession. Um, so another thing to know just for your research is that in Europe, they use a measure called HICP inflation. And this is a little bit different from what American statistical agencies report. In America, we have CPI and PCE inflation, and they're similar, but they're not exactly the same because there's slight differences in the basket of prices that they look at. So CPI inflation, for example, includes the cost of housing, whereas HICP inflation does not. And this is why there's slight differences. But it turns out that as of December, um, inflation in Europe, HICP inflation is 2.4%, and PCE inflation in the United States, which is what the Fed targets, also happens to be at 2.4%. So they can diverge a little bit, but not that much. But keep in mind when you're looking at the statistics that there, you want to be comparing the same thing or similar things. So central banks, we're going to start talking about this in a bit, have started cutting interest rates because inflation's back to target. But one of the key risks and key things that people are worrying about is, are energy prices going to stay low? Because energy is such an important, you know, baseline product that determines the prices of a lot of other goods and services, another spike in energy prices would be a problem. So obviously, we don't know. One of the reasons why people are worried is because of these wars in Ukraine and also the conflicts in the Middle East. People are worried that this could disrupt energy supplies and cause another spike in energy prices. This would be, a challenge for central banks figuring out, should they respond to any kind of temporary shock in energy markets. But another issue that I wanted to highlight is that even though the blue line there is the price of natural gas in Europe, and the red is the price in the United States, the war in Ukraine caused a much bigger impact in terms of how much energy prices spiked in Europe. Now, that's mostly over, right? The big spikes have come down. They haven't come down all the way. So natural gas and electricity prices in Europe are still maybe 3, 4, 5 times the amount that they are in the United States. And this is what I was highlighting was one of the problems that the manufacturing sector was facing. Gas prices have come down, but not all the way. And so they're at a competitive disadvantage in terms of their fundamental energy costs. All right. So we've just covered GDP, unemployment, inflation. I've tried to give you a very quick and easy overview of what this data tells you and how to think about it in the sense of what it means for the real economy and for people's welfare and well-being.